Hey everyone, in this video I'm going to highlight two catalysts for NEO stock investors that could boost the company's sales, revenue, and ultimately profits and cash flow in 2023 and beyond. So let's get right into it here. And the first catalyst is the sales network. So the company's co-founder and CEO highlighting that around June, they realized that inside of the company, in terms of the number of salesperson, as well as the capabilities of selling products, they lagged behind competitors in the market. For example, for those luxury brands like BMW and Mercedes, the size of their sales team is 6 to 7 times ours. And so starting from June and July and August, they've taken a more active manner in improving their sales capabilities. And with that, they hope that the company will be able to support the new orders of 30,000 units per month. Per month. That's a big increase considering that the company delivered less than 24,000 units in the second quarter overall. They're now looking to jump up to 30,000 units per month. And so by the end of September, they will be able to realize that target. By the end of September, they think they will be able to realize that target. And if they do, that's certainly going to be a catalyst for the company's sales. And then, of course, with more sales will come more profits because the company will leverage its fixed costs and deliver greater efficiency on the bottom line. And then, of course, if the company achieves profitability or achieves better profitability, then that's going to be a positive implication for the stock price. The second green flag or catalyst I'm going to talk about for NEO is profit margins, specifically the gross profit margin. So in the second quarter, the gross profit margin, as shown in their financials, their vehicle margin was 6.2%. The key reasons are that sales production volume at a lower level are driving higher manufacturing costs and other cost allocation to unfavorable circumstances, right? So if you've got a certain amount of fixed expenses and you make a certain number of vehicles, then those fixed expenses are going to be spread across those 20,000 vehicles. For instance, in the second quarter, it was something a little over 23,000 vehicles delivered. But if you deliver, let's say, 50,000 vehicles, then those same fixed costs are going to be spread across 50,000 vehicles. So the fixed cost per vehicle gets cut in half or gets cut more than in half. And so by increasing your number of vehicles delivered and sold, you leverage those fixed expenses across more units and thereby increasing your profit margin. Another reason is that there was a lot more promotions in the first half of the year and the marketing efforts to begin the product transition period. Remember, NEO is and has launched several new models in the middle of this year, and the last new model will be coming out in September. So typically car companies, and this is common for all car companies, they offer you discounts, promotions, and incentives to get rid of their older inventory, the older models, so that it makes room for the newer models coming into the market. So for that reason, the company's margins were impacted in the second quarter, but that should be done with heading into the third and then of course the fourth quarter, because then it'll refresh the cycle. It'll have newer inventory, fresher inventory with better customer demand, less need for incentives and promotions, and the company's targeting to achieve double-digit gross profit margin in Q3 and then 15% gross profit margin in Q4. So nice steps up here from the 6.2% in Q2 to, let's say, 10% in Q3 and then 15% in Q4. Nice steps up in the company's gross profit margin, which NEO stock investors will see as welcome news, to be sure. But that's all for this video, covering two key catalysts that could boost NEO stock price in 2023 and beyond. I want to thank the Motley Fool for sponsoring this video. Visit fool.com/Parkev for the 10 best stocks to buy now.